Hello friends, welcome to Stock Mart channel. Here in this video, we're going to discuss about the 6 important ways to protect our profits, what we normally receive from our investments. Money is a major source for everyone in our lives. For many people, money is a source of security and a means of achieving their goals and aspirations. It can be used to pay for basic necessities such as food, housing, and healthcare, as well as for luxuries such as vacations and fancy cars. For others, money is a way to gain power, status, and respect in the society. In order to accomplish our goals and aspirations, we invest our hard earned money in various asset classes like liquid funds or cash, debentures, bonds, fixed deposits, recurring deposits, properties, bonds, government security treasury bills, equities, etc. We all agree that the interests or profits are very important and plays a vital role in our daily lives. In this video, we will be discussing about 5 ways to protect our profits if we would have invested in equities. Generally, there are two types of investors: short term or medium term investors and long term investors. This video is applicable for short term or medium term investors who intends to hold stocks within an year or within 2 years investment horizon. This is not applicable for investments of 10-year investment period or more, as these are long-term stocks assuming of buying it with an intention to hold and not to sell it for at least a decade or passing this to the next generation. Also, we cannot time the market as it is very volatile in nature. Presently, Sensex is trading at the levels of 65,588 rupees and Nifty is at 19,510 rupees. If the markets are high, we will be happy. But the question at this point of time for all the investors is, if the Sensex goes down by 15 to 20%, that is, if the sudden shortfall happens, how much will our portfolio goes down? Have seen most of the investors' portfolio goes down by 40 to 50% if the market goes down by 15%. Question is, have we replaced our portfolio? Or our portfolio is protected with less volatile or fundamental stocks? These are the questions we need to think about. Normally, there are three types of investors based on the risk taking ability. They are aggressive investors, moderate investors, and conservative investors. Aggressive investors. Such investors are fairly experienced with ability to take high risk. These investors usually have a larger portfolio. They normally trade in high risk, high reward instruments like futures and options. When it comes to equity investing, approximately 60% to 70% of stocks are invested in micro cap, small cap, and mid cap category, and rest in large caps. Moderate investors. A moderate investor prefers investing in less risky investment options. However, these types of investors take some risk according to their tolerance. They hold investments across different asset classes. They have tendency to invest approximately 50 to 60% in micro cap, small cap, and mid cap category and rest in large caps. Conservative investors. The primary focus of conservative investor is capital preservation. They don't crave to earn high returns. Hence, they prefer investing in fixed deposits, public provident funds, etc., and have smaller portion in equities or stocks. Approximately 80% of equity investments will be in large caps and remaining will be in small cap or mid cap stocks. Whatever is the investing pattern, it is important to have a cautious approach when the market is volatile, that is, during its ups and downs. The markets will be in a mix of bullish and bearish trend, but if you look at the larger picture, the market always goes up and gives very good returns to its shareholders. The bullish trend or bull run happens because of three essential factors. The first one is due to actual growth. When company produces consistent increase in sales volumes, revenues and profits year on year, then of course the share price of the particular company increases and goes up. as the investors' confidence and sentiments drives the share price. This also increases the market capitalization of the company, which results in positive impact growth in stock market. This is an actual growth. The second growth, that is the rally can trigger, is due to its liquidity. Today, what we are experiencing is a liquidity driven market. Many economies or countries practicing their quantitative easing as they are printing more money. Quantitative easing is a form of a monetary policy used by the central banks to increase the domestic money supply and encourage economic activity. This results in circulation in the trade, which impacts stock market positively and the prices goes up. Finally, sentimental factor. Of course, the sentiments are very high today. We are having a very positive forecast that many investment houses and big name ACE investors believes that Nifty itself will cross 90,000 to 1 lakh points. And Mr. Ramdev Agarwal, the co-founder of Motilal Oswal, having an opinion that Sensex will touch and cross 2 lakhs. India's stock market are projected for good growth for long term as the economy is improving, so as its urbanization. And India's GDP, which is projected to rise from $6.6 trillion in 2030 to $13.2 trillion in 2040, and subsequently $22.2 trillion in 2050. But what if there are any falls in short term or during bearish period when the market falls or crashes? Is our portfolio protected? Now, if we follow these 5 important criteria, surely we can also reduce the fall or reduce impact of the fall and protect our investments. So the number one is avoid large position at this point. Many retail investors, what they do is they will have complete greed when the markets are at high. They will feel that they have already missed the bus and they will take large position at one go when the markets are at very peak level. So never ever put all your money at lump sum at a time. It's always better to divide your investments into multiple regular levels and invest. There are 3 segments in the market, that is cash, intraday, and derivatives, normally called as futures and options. It is always better to avoid leveraging. Never take large positions in leveraging. For example, when people take out a loan to purchase an asset or with the hopes of growing their money in the future, they are using leverage. For instance, if you take out a loan to invest in a side business, the investment you pour into your side business might work or not. So there is a high amount of risk involved which negatively impacts when there are falls in the market. So never ever take derivatives position at this point in time. The next is checking whether our stock portfolio is quality or not. Because when the market comes down by 15% and when our portfolio is not fundamental, then the stock price can go down to 40 to 50%. If we are holding any stock which are fundamentally not good, then probably it is time for us to dispose them and change the portfolio with good quality stocks. We need to analyze the quality, leadership, financials, valuation, etc. of the company, and then we need to construct our portfolio. The next one is we need to practice asset allocation. We have seen that most of the investors put all their money in one industry or on one particular category, like all the money in mid cap or all the money in small caps, etc. So, which is not a good approach. We need to identify the objective when it comes to return expectation. So, we need to assess how much percentage we need to present in large, mid cap, and small cap categories. If we are an aggressive investor or moderative investor or even a conservative investor, whatever is the risk taking ability, it is better to invest after making a thorough research to avoid losses. Then we would have seen a good profit appreciation in the portfolio. But if that are due to unrealized profits, then we may book some profits. It is probably a good time to shave off only the profits and put it in a low risk scheme, for example like index funds or index equity mutual funds, etc., which acts as a balancing act, and, most importantly, it will help investments during the time of volatility. Historically, in the long term, investors who stayed patiently for minimum 5 years or more with good quality fundamental stocks had experienced good profit percentage compared to the other asset classes like gold or fixed deposits or recurring deposits, bonds, treasury bills, or any debt instruments, etc., which cannot beat the inflation. India's economy and growth story is very bullish, and if we stay invested for long term, we can get benefited with utmost returns. It is only that we need to exercise caution. Finally, we need to rebalance our portfolio. It is always advisable to constantly monitor the results of the companies, that is, the quarterly results as well as the yearly results, which gives us a clear indication of the company's performance. By the study, we can retain the good stocks and dispose of the ones which are underperforming. If the stocks are not performing due to external reasons, due to raw material costs, or due to increase in crude oil prices, or due to recession, or government interference, etc., then we may retain them, provided these are fundamentally good quality stocks. So based on all these analysis, we can rebalance our portfolio accordingly. So if we follow these strategies, we can protect our profits and minimize the losses from our investments. If you know any other methods, do mention the same in the comments box. And if you like the content of this video, then please like, share it with your friends, and do subscribe for more such interesting videos. Jai Hind.